Our first source document for credit transactions will be sales invoices. We have 4 source documents to worry about for credit transactions, and this first one will be a sales invoice where it's issued by our business when it makes a credit sale of inventory to another entity, so a customer. And that customer agrees to pay us cash in the future, for example, 30 days. What will it look like? Well, every sales invoice is different, but there's going to be some fundamental things we can look at to determine who sold what and who they sold it to. So in this case, we've got an invoice and it says Cool Cardigans applies a markup of 100% on all sales of inventory. So we can see the name at the top of the document, in most cases, will always be the seller or the issuer of the document. So Cool Cardigans is making a sale. Who are they selling or making a credit sale to? Well, that name will usually be underneath the top. So the name somewhere further down on the invoice is usually the buyer or the receiver of the document. And in this case, it says Sue Ellen Mishke. And we need to be able to read these in the real world as well, because this is how business is done. It's not done with a list of transactions like you might get in the textbook. It's done with documents. And what we can see here is it says invoice. It's got an invoice number. Also says tax invoice. What does that mean? Well, in an earlier video we said tax invoices just mean there's GST in the transaction. That actually doesn't mean it's necessarily a cash or a credit sale. It just means in that transaction it has GST. So that part there actually doesn't tell us that that's a credit sale. We've got a date. We should have some ABNs. In the real world we need to look for those. They may or may not be there in our subject. It depends. We've got the name of the customer that it's been charged to. We've got these credit terms, which we looked at in a previous video, what they mean. And then this could be anything. This could be whatever the business that we're doing the books for is selling. And in this case, we've got a SKU, which is a stock keeping unit number. We don't need to know what that is. We might just see it on a document and wonder, do we have to do anything? That's just how the business identifies, in this case, the red and blue cardigan size medium. It has a stock number. So we've sold 5 of those for $80 each for a total of $400. And then we sold 3 beige cardigans size XL for $100 each. And you add that up, that comes to a subtotal of $700, 10% GST for a total of $770. So we just need to process that. And I guess the first thing is determining from the document what happened. So if we could summarize what happened, Cool Cardigans made a credit sale of inventory for $700 plus $70 GST to Sue Ellen Mishke on the 7th of February. The cost of sale is $350. Now, what's interesting about that is we cannot determine that from the document. No business in the world puts the cost price of the inventory on the invoice because then the customer can see it. So we cannot determine what the cost price is unless the question tells us. And in this case, it said it's a markup of 100%. So that would be a cost of sale of $350. And the source document that this was all recorded on was invoice CC 101 there. What are the credit terms of this invoice? So this is the little numbers here, 2-14 and 28. The customer, Sue Ellen Mishke, will get a discount of 2% if she pays this invoice within 14 days. Now, in this case, that would be if she purchased on the 7th of February, 14 days after that would be the 21st of February. And she has a grand total, N28, that means 28 days to pay this invoice. And 28 days past the 7th of February is the 7th of March. How would this go in the general journal? Well, it's actually going to go in exactly like we've been recording credit sales for a couple of chapters now. It's just that we're doing it from a document instead of from a sentence. So the first thing we'll always start with is the date. We can do our debits and credits in whatever order we want. I always do the debits first for the sale, so that's where I'm going to start. And I'm going to start with the account called Accounts Receivable S. Mishke. That's an asset. And after this, she is going to owe us $770. So that asset called Accounts Receivable is going to go up. So that will be a debit. That will match up with 2 credits. There'll be one, which is sales. Sales is a revenue. And we can see on the document, the sales is the subtotal here. So we take the GST out. And that's a revenue going up by $700. And our rules say that must be a credit. We've also charged GST, and although we haven't got it, the tax office says we have to pay it to them. So our GST liability goes up. And when a liability goes up, that will be a credit. And we've got our mini sort of transaction here within the greater transaction of 1 debit matching up with 2 credits for the sale amount. But we can't have a sale without a cost of sales, so we need to deal with the cost of sales expense. And remember, we can't determine that from the document. It's never going to be there. We don't want the customer to see that. So we have to have been told what it is. And we were told it was 100% markup So that's 350. So that's an expense going up. When an expense goes up, that will be a debit. And lastly, what did we have to sacrifice to make this sale? We had to give up inventory. And inventory is an asset. So we will have less inventory after today. So that will be a credit going down. We might get asked to make an oration, and we always want to give too much information just in case, and we'll say credit sale inventory to S. Mishki, and most importantly, we have that document number, invoice CC 101.